The volume indicator is often called the fuel of the market. While price tells you where a stock is going, volume tells you how much conviction is behind that move. Professional traders rarely use volume as a standalone buy or sell signal. Instead, they use it as a secondary confirmation tool to validate price action. In a healthy bullish confirmation, we want to see rising prices accompanied by rising volume, indicating high participation. Conversely, bearish confirmation occurs when falling prices meet rising volume, signaling aggressive selling pressure. If you see a price movement on falling volume, whether it's a weak pullback or a rising price, it often points to a low conviction move or a looming reversal. One of the most critical warning signs is exhaustion divergence. This happens when price reaches a new high, but the volume is lower than the previous peak. Think of it like an engine running out of gas while trying to climb a hill. A reversal is likely looming because fewer buyers are willing to step in at these higher levels. Be wary of the retail fakeout. Breaking above resistance on low volume is almost always a trap. Professional confirmation requires a high volume spike, showing that institutional big money is backing the move. To find the absolute top or bottom, watch for climax volume. A buying climax is a vertical volume spike after a long upward move. It means everyone who wanted to buy has already done so, and the trend is exhausted. On the flip side, a selling climax is a panic spike where the last weak hands finally sell out. This massive capitulation often marks a true market bottom, providing a high probability entry for the observant trader. To trade like a pro, you must shift your focus from when volume happens to where it happens. VWAP, volume weighted average price, gives you the true average entry for the day, while the volume profile identifies high volume nodes. These nodes act as literal brick walls of support and resistance, because they represent the price levels where the most trading occurred. Finally, use relative volume, RVOL, to gauge anomalous interest. By using the volume profile, we identify high volume nodes, dense clusters of trading that act as literal brick walls of support or resistance. Remember, the institutional footprint. Large institutions cannot hide their moves. If you see massive volume signatures without a major change in price, that is accumulation. The big players are quietly absorbing shares before the engine revs for the next big move.